All right, Fair Lily, let's get started. Good afternoon.
Already? You're just throwing me to the wolves like that?
Oh, no. I'm gonna do my part. I need
All
to do some
right.
housekeeping first.
Well, thank you. Well, thank you so much, Jeannie, and of course, Pace, for your continued partnership. I know that I've been working with you for quite some time, and since I was with Bank of America, and then eventually I turned into an entrepreneur. And so, thank you again for all your support. And yeah, so today we are going to be talking about owning commercial real estate as a business strategy. And just so you know, my company, and I'll talk about that in just a moment, is really about strategy and doing things intentionally in a way that things are going to make sense and also support your growth. So just so you know, you're probably going to hear the word strategy throughout the presentation, and there it is. It's also here on my title. But before we jump into anything and who I am, because obviously you need to know who I am to make sure that you're talking to a subject matter expert, is I wanted to go over some stats that are related to today's workshop and why today is so important. So there is a market size right now currently of $20 trillion across the United States for commercial real estate. So which is huge. Something else that I do want to mention, and this might motivate you a little bit to maybe get into that space, is that the so that's information from the Federal Reserves. But there is surveys out there from multiple different conferences and just large data from Dave Ramsey and then Andrew Carnegie, and where they have reported over 90% of millionaires have not stopped at investing in real estate, but then also have moved forward in commercial. So not only are they doing residential, but 90% of them that have become millionaires that were not millionaires prior have become millionaires after owning commercial property was a factor of that. And I wanted to tell you a little bit about the reason as to that. So there is, whether you own the property, as far as you have your business that you're moving in to the property, you're moving your business into the property, or let's just say that you're renting that property to somebody else. You control the market as far as how much money you are able to ask as far as rent, and you create your own appreciation. What does that mean? You create your own equity, you create your own market price. Not necessarily market price, but what the property is worth, because what happens is you could actually charge based on market rates. The location also matters as well. The demand is also something else that matters. But then, not only that, the type of property and the businesses that are moving into the property. So you have the ability of charging based on the business that's coming in and the revenue that they have. So there is some property owners that charge a percentage of, and it might sound a little brutal when you're on the other side, but they charge on the revenue that is actually being brought into the company. So, some things to think about and just keep in mind while we're doing this presentation. Now, if you don't know me, which I'm not seeing too many names out there that I do recognize, but if you don't know me, just a little bit about myself. I was in finance for over 20 years, and the last, ooh, 16 years or 17 years of my career, I was working with entrepreneurs and business owners and entrepreneurs. And what ended up happening is there was changes in my role at the last bank that I was at, and then I just decided I didn't want to go and be in any other type of role, management role, any role that was available. It wasn't for me anymore. I wanted to do bigger things and being able to help businesses at a bigger capacity, and not just a checking account or a loan or a credit card, but being able to provide solutions and be strategic on being able to grow businesses. So I created Evia. So I am a founder of Evia, where we empower businesses to fund, innovate, and grow. And we do that by providing access to capital consulting. So where to go, especially if you were denied by the bank, or if you're a startup business. There's a lot of myths out there that you can't get any type of funding if you are a startup. So we definitely guide you on how to do that. And we also do AI consulting, and we have a partnership with our sister company that does software development, and we have an AI platform and where we can incorporate to be able to automate a lot of your work. And of course, We also do, when the growth stage, we also do digital marketing strategies. So as you see, we're a growth partner to businesses and to be able to help them strategically how to grow and make a plan for them so that they are successful. Now, what are we going to be talking about today? So, what's on the agenda? So, owning commercial real estate as a business strategy. We're going to talk about the difference between leasing versus owning commercial real estate, investment property, because maybe some of you don't have a business that you want to move in, but maybe you just want to jump right in into investing. How to qualify using your business to acquire a property, acquisition roadmap. So, we're going to give you some guidance on there. Wealth and legacy, and we're going to give you an illustration scenario so you can kind of have an idea of how everything works. Because we do have a jam-packed schedule today, I will be asking questions every few slides. Typically, I will take them as you go. If you do put them in the chat, I will most likely be able to answer them. So I'll try to keep an eye out on what's being asked. So just wanted to keep that in mind. And then also at the end, I will be asking if anybody has any questions, anything that you want maybe tailored to you. So we just want to make sure that I put that out there as well. Also, if you could do me a favor, if you are in the market for commercial real estate, if you can please put it in the chat, or if you're just here for educational purposes, just curious on what type of audience that I have so I can kind of try to tailor it for you today as well. Now, let's talk about owning commercial real estate as a business strategy. So being able to move from renting a building to actually acquiring a building and now having a little bit more control, not only more control, but a long-term legacy that you can build for your family, for yourself, and also do it through your business. Now, we're going to be talking about lease versus owning comparison, and then how to be able to structure your financing, and then also, we're going to be going through the wealth building and the legacy and how to kind of transition that out to your family as well. Oops. Okay, my thing is frozen. Oh, so sorry. Okay, there it is. All right. So the strategic shift. Let's talk about most businesses rent space, but wealthy businesses often own it. So being able to go from renting a property to actually owning a property, there's actually a lot of different benefits. Now, when you are renting a property, yes, you can use it for your taxes as far as being able to maybe write those things off depending on where you're at. But also, being able to buy a property, you could actually grow some wealth along with it. So just think about this. Every time that you are paying rent, you are actually essentially helping the investor that owns the property being able to pay off that property. So what comes with that? Your rents usually go up. There's a lot of different changes. Maybe you have to do some renovations for the property. And of course, the landlord is going to be, yes, of course. I had one of actually, I can't say what industry, but he is in, but he does have a warehouse. And one day I went in and he just did a huge remodel on the warehouse. And the reason he did it is because he needed for his efficiency and being able to store things in a certain way, but then also create an office within the warehouse. So who ended up benefiting out of that? Because it is a huge building, the landlord. And yet he is still there, right? So if he's ever to leave or needs a bigger space, who's going to take advantage of that? The appreciation that comes along with that is going to be the owner of the building. Ownership. So being able to own a commercial property is going to create equity, control, and future options. So not only that, let's just say that you do move your business in and now you are retiring, or maybe you sell the business and you are no longer needing the property. You can continue on with the property and being able to rent it out to other people, rent it out to other businesses, and also be strategic as to who you rent it out to. Now, there's also some benefits of also where you have the location also, right? So I'm going to tell you a quick story about something that happened when I was actually going out with one of a dentist that he was looking for a location. So we had gone to a liquor store that he was essentially going to convert it into a dental office. And as we're there, we can't get into the property, but we were showing the property outside with the realtor, the commercial realtor. And what we ended up finding out is that I guess the person who owned the liquor store had passed away. But while we were there discussing about which property we were going to go see next, there was a lot of people that would come in and try to open the door and they'd look, knock, look inside. And there was just like a traffic of people. Now, it was really great location. There was a lot of traffic going on. And so what ended up happening is I said, "Hey doc," I was like, "Have you ever considered having a liquor store?" I was like, "Hey, did you see how many people?" And then the realtor actually realized that as well. And he said, "You know what?" He's like, "Well, I could always wait until buy another property, or maybe right now is not my time." He's like, "Maybe I should take this as a side of me buying a liquor store." He's like, "Did you see how many people?" I was like, "Yeah, that's what I'm saying." I mean, I said it jokingly, but he actually saw a vision. So not only did he end up acquiring the liquor store, but he also was able to get an additional form of revenue. He saw an opportunity and he took it. So you also have to be prepared for those and maybe pivot and as to what you're looking for. And but yes, that was going to be a dental office that he was going to essentially be converting into a dental office, which ended up being a liquor store. Having a legacy for your family. So being able to build and outlive a strong operating year. So this is something that you can leave to your family or just, have it ongoing after your retirement. That could be part of your retirement income that you would be getting. So own the address that powers your business. So that would be a strategic way of making additional income. But then also, I just told you at the beginning, as far as some stats that are related to today's webinar. Now, let's start comparing lease versus own. Okay, so we kind of went over that earlier. So, renting, you're typically you have operating expenses and it's not an asset. So, you got to remember this is money that is just going to waste. It's going back to the property owner. It's not necessarily benefiting you as a business owner. Some of the lease terms can reset and escalate raise costs over time. So, you don't know how many times there has been where maybe they have a really good location and there's people that come and contact the owner and say, "Hey, I want to be able to move into that property." So with that being said, once the lease terms resets, that's pretty much open up to a lot of the things that they could actually charge more, or they may want to. I know even like at one of the banks that I was working at, they had to get rid of the lease and they had to get rid of the property that we were operating out of because they raised the rent. I think it was like 3 or 4 times than when they were paying. And so it just didn't make sense. And so they ended up, another bank just moved right in and it was at a great location. Another bank was maybe in a better position or saw the opportunity. That bank actually moved out and then another one moved in. So that kind of gives you an idea of how much leverage you actually have as a commercial property owner, especially when you're in high demand of a location. Space decisions remain tied to a landlord's property. So that is very true. However, if I did mention the story earlier about a client of mine, how he went ahead and actually renovated the whole entire inside. He did a whole remodel. And also, you got to think about it, right? You have to protect your brand too. So, yes, it might not be your property, but at the same time, it's a brand and who you want to present yourself to as far as your actual business. So on here, we see base rent and then we see the escalations just at 3% here at the lower right. And just to give you like an illustrative 10-year example. So 5,000 monthly rent times 120 months, that equals 600,000. So that's paid with no equity that you have created. However, if you do own the property and you have been paying that for 15 years, of course, that is money that is going to appreciate. You are going to gain equity on that commercial property. So if a lease includes a 3 annual increase, your total cash that rent exceeds 680,000 over the same period. And this is just really being conservative, right? I've heard of 5% and just, depending on the areas that they're in, they raise the rent and sometimes it's just really cutting into your bottom line. I wanted to quickly, for those of you that maybe are in the market or maybe you have a warehouse that you are in. I've had where I take a look at their tax returns and my consultant hat comes on and I'm like, you're paying $24,000 for this manufacturing warehouse. And in different times, and maybe it could be, it just really depends on the area that you're in, there has been times in where I remember they went from 24,000, and I believe with like taxes and insurance and everything, I think they went down to like 12,000 or 13,000. I can't recall because I've been in the business for quite some time, but I do remember it was either half or a little bit over half. And that would happen multiple times, because that would happen multiple times. And the great thing about it is that when you are moving your business into another property, they are able to use that as part of your qualification, because now you're going to be applying that, let's just say 24,000 or whatever your rent is, into the new property. And so for him, as soon as he saw that, he went, called his wife, and immediately he was like, we need to get on this quick. And so they were able to immediately, not only were they already profitable because we were able to get financing through the bank, which I don't know if you're aware, but you have to show your gains and your profitability to be able to afford property when you go through the bank. So they were already profitable, but then they were also gaining about 144,000 additional a year by just buying a property. Not to mention, if you talk to your tax professional or your CPA or accountant, there are additional benefits such as depreciation, interest, and things like that that you can actually write off or actually get a break for having a property. Now, owning, let's talk about owning, which is my favorite part of things. So payments include principal pay down instead of only occupancy costs. And then what does this mean? So every time that you are paying towards the property, unlike the lease, you are actually getting equity, and you are actually paying down your property versus it just going into waste and a write-off on your tax returns. You gain control over built out timing and long-term use. So what does this mean? That your property could actually appreciate, so you're gaining equity, and you're also getting control over being able to own the property. We talked about appreciation and equity that it could create for the future borrowing power. So this is something in where you might be able to actually take money out or get a line of credit or something like that, if the times permit, because economic changes could always happen, and being able to buy other properties or even expand your operations, or maybe buy even another investment property. So those are some of the things that are beneficial. Lease, as you can see, um, is pretty much money going to waste. Now, you may not be there yet, but the goal is, with the resources that you have at Pace and the resources that you have, like partners like myself, we can definitely get you ready so that you are bankable and you are able to get financing. And sometimes you might not get financing through the banks, but you might be able to get financing elsewhere through alternative financing measures. Now, I did want to throw investment property on here because you may not have a business that you need to move into, but you also may want to invest in a property. So, owner occupied equals stability. So that means owner occupied means when you move your business into the property, and then you have investment property. This is more like scaling. You actually get into the next level. So being able to create additional income streams. So not only having the only income stream of having your business, but or maybe you have a W-2 job or a 1099 job, or maybe you're self-employed. So that would be an additional income. And then also build long-term equity and cash flow. So this is additional cash and also additional equity that you'd be building for yourself and your family. Expand beyond your business location. So might be able to go outside of where your business location is and have other properties elsewhere. So your business pays for one property, your portfolio builds wealth. But of course, either way that you go, you can always build wealth either way. Okay, my mouse is very sensitive, so my apologies. Okay, before we get into what lenders want to see, I wanted to stop and regroup and see if anybody has any questions or anything like that at the moment.
Yes, there's a question, Valerie.
Mm.
Should I read it for you?
Please, I don't. Oh, here it is. I see
Yes.
it. Also says, Hi Valerie, the SBA recently changed its rules. It will no longer lead to anyone who is not a U.S. citizen or natural U.S. citizen, and they will no longer lend to those borrowers or small investors a borrower's project who have defaulted on a VA, SBA, or other government loan. Is this starting to change lending strategies? Well, I want to tell you that SBA, and we'll get into that shortly, but SBA is not the only way that you can get a property. SBA is specifically for business owners that want to move in their business into a commercial property. And those down payments start at 10%. And the reason that SBA does that is because obviously being able to drive economic growth by owning a property, they make it easier than a conventional loan, which we'll get into shortly, to be able to gain a commercial property. So just because you're not a US citizen, you've defaulted in the past and things like that, that doesn't mean that it ends there. And that's what I always tell my clients is just because the bank denied you or you weren't able to get approved through SBA, that does not mean that you're not capable of getting a loan. That just means that that's not the right program and that is not the right lender for you. Now, is there a price to pay? Yes, and we'll get that into that shortly, but hopefully that answers your question. That's actually a great question. Thank you. So, what lenders want to see? They want to see clear use of funds. So, you don't know how many times, especially when I worked at the branches and I would get the incoming traffic before I was just out in the field. People would come in and, Valerie, I need $1 million. And I'm like, okay, that's great. What do you need the funds for? I just need $1 million. I'm like, okay, well, if we're going to give you the money, we need to know what those funds are going to be used for. And it turns out that they needed multiple different things. Maybe they needed a line of credit, equipment, and also buying a commercial property. But then also that $1 million maybe included tentative improvements. Very important that whoever you are dealing with, your banker, your lender, commercial lender, whoever you're dealing with, that you tell them exactly where you're going to be using the funds for, because not only us as consultants and bankers can help you strategize as to what type of loans to get for what type of collateral. So we need to know what those funds are going to be used for. In that case, there's been some cases where we've gotten, I think the most that I've gotten a client, I think it was I think it was 16 different loans. So it was like different trucks, line of credit. They didn't need a commercial property. They needed equipment, different equipment, and each equipment. And there was a strategy behind that. Not going to get into that, but yes. And also, different equipment might have different pricing and interest, and then also in terms. So very important that you communicate that with whoever you're dealing with, a consultant, or if you're dealing with a banker or your lender. Credit strain. So that's definitely something that they take a look at. They want to know what kind of history you have and if you're responsible for repayment. When I do my credit workshops and when I do my access to capital workshops, I'll come out with a big check and I'm like, you know what? It's Val's best company. I need somebody to sign this $1 million check. And I put them in the hat of a lender of like, you're responsible that if I don't pay this back, you are responsible for that. So they start asking questions all of a sudden. What is your credit score? How much money do you make? So those are the things, and that's the reason why these lenders are looking for that. Now, it doesn't mean that just because your credit score is maybe not up to par or up to their liking that you can't get a loan. No, just going back to like the question that was just asked, that just means that that might not be the lender for you. You may have to go through different means and alternative financing. Cash flow support, so current or projected ability to cover debt. And when we say current, it could be current and it could also be past or projected. Now, current and past, that's what usually the banks will look for because they want to know what you've done in the past. They usually want to see what you've done in the past 2 to 3 years, and they usually will only consider you if you've been in business for 2 to 3 years. Now, alternative financing or investment and things like that, they can take projections, they can take what rent is going to be coming in, the revenue that you're going to be making eventually because of the plan. Maybe you have a business plan, marketing plan. Maybe you're incorporating a software with that AI that's going to maybe make you even more money or facilitate things. So all of those things, these are some of the things. I'm sorry, when it comes to cash flow, those are the things that they're kind of looking for when it comes to projections. You may not know how to do projections, but you can hire somebody that can actually help you with that. And I believe Pace might also do that as well. So if they are looking for that. Collateral and owner support. So asset and guarantees when required. So what does this mean? They'll want to know, what is that collateral that you're using? Is it commercial property? Is it a combination of tentative improvements? Or maybe you're going to do a build out once you do. Is it a new construction? All that information they want to see, and they want to know that information. Industry experience, especially if you are a startup, they'll want to know if you have any type of experience, or if you came from a restaurant, now you're doing financial services, like, okay, your experience, like what experience you're bringing into the table. They want to make sure that they essentially, it's kind of like a little bit of an interview. They do interview some of the clients as well as lenders, so that is something. So don't be alarmed in the event that does happen. Now, what are some of the things that the lenders look for when it's owner occupied? Typically, especially with traditional loans, which means like SBA and certain programs, they want to see that you are going to be occupying your business at least 51%. 51% of the property, because that means you have high stake in the property, and you're not just really going to be using it for investment. And again, for those type of programs, they want to know that you're going to be using that amount because of the programs that they're putting you into. And how do they determine that? They usually do an appraisal. They do an appraisal and they go in and see and measure if you are going to be using 51% or not. New construction, they typically do require at least 60% and also require a growth plan. Those are a little bit more complex. But what I have found lately, especially here in the Inland Empire, that because there is a scarcity in some areas of commercial property, what they're doing is they're actually building a new construction. So they're buying the land and they're just doing a new construction as a whole. Investment properties, they want to know your rental income and if it supports the payment. So there has been times and where we find a commercial property for an investor and it's paying itself, but maybe that person is just selling because they're already just ready to retire, they're moving out of town, family changes, they have to settle for divorce or settle for, lawsuits and things like that. So those opportunities are actually out there. So if you have not been penetrating these type of markets, definitely get together with a realtor, but first you'll have to get with the lender. Why? Because you want to get pre-qualified before you go shopping. So usually when you go shopping, ideally we should know how much money we have in mind or budget to be able to move forward. So let's see what else. Strong tenants. So they want to see that reserves are required. And sometimes they may want to ask for that information in order to be able to approve a loan. So those are some ways that you might be able to get approved for that as well. But also, as I mentioned earlier, if you, let's just say, wanted an SBA loan, but you're not able to get an SBA loan, it doesn't mean that you can't get a loan as a whole. It just means that you're at the wrong place or the wrong program. And so in here, I wanted to add that strong deals don't just get approved, they actually get better terms as well. So here are some common funding programs for both owner occupied and investment properties. And these are the three, I just picked the three most frequently used. I do want to let you know that it does not stop here. There are so many programs out there that are outside the traditional world. And there's even still things where you can get qualified with bank statements, you can get qualified with projections. So, what you see here is not what's limited. So, if you're truly looking to purchase, make sure that you are working with, Pace. You have a resource as Pace, ourselves, or a business consultant that can actually lead you to the right lender that can actually make that happen for you. So owner occupied, there's SBA 7A. Typically the SBA's loans, they typically max out at 5 million. and those all things could really change. But for an SBA 7A, these are flexible for purchases, refinance, working capital, and lower down payment. So those could start anywhere from 10 to 15% depending on the day. And then also SBA is 50 SBA 504 can also be used for real estate and also equipment. Those are also low down payment and then also long-term fixed rates at a portion. So typically 25 years is typically what we see for SBA. Those can change depending on the day, on the month, or economic changes. So that would be for SBA. These are owner occupied. There's also conventional financing. So this is typically what banks will look at, and this is going directly with the bank. So let me tell you something really quick about an SBA. SBA, just look at it as the government or as, yeah, the government agency, SBA, being a co-borrower to you. So what they're doing is they are guaranteeing the lender that in the event that you as the consumer is not able to pay them back, they will go ahead and pay back a portion of them. So that way they don't lose them so much money. So it's that extra safety net that the SBA will do. And SBA does it because obviously it's to their best benefit to create wealth and drive economic growth. So they have these programs to be able to drive that as well. Conventional financing, this is usually banks and credit unions. However, some of the smaller lenders will also have conventional financing. And typically they will give you better terms as far as the interest rates and things like that. Again, it just depends on the day and where the economy is or how aggressive SBA is doing with their rates at the time. But it typically requires at least 20% down and then also really strong financials. What does that mean? That it can't be one of those things of, you know what, my revenue, Valerie, was 200,000 last year, but it says on paper, but it was really a million. They want to see everything on paper that you are filing those taxes with those numbers, but actually being able to show that you are able to repay back the debt based on the tax returns and the filings that you're doing. Investment properties, these are the three most commonly known. So the conventional loans, again, so this is bread and butter of investment real estate, and then based on DSR. So what is that? Is income of the property. So that would be conventional loans. And again, they want to see how much rent money they're already getting, or if you don't have any rent money coming in already historically, then they will want to know if you are capable of paying them back without having that rental income. DCSR loans, those are debt service coverage ratio loans, which I'm surprised they call them that, but that's what they're called. So that's a bank term. And these actually focus on cash flow and not necessarily the borrower's income. So they want to know what the property cash flow is, which actually is not a bad idea to find a property that could actually pay for itself. But these are DSCR loans. DSCR loans, debt service coverage loans. And then there's also bridge loans. So I don't know if any of you are in the market right now, but I'm going to tell you, if you are in the market, you need to be prepared and ready to go with your financials, be pre-approved, have your letter of intent, because a lot of the good properties, they go on really, really quickly. So when that does happen, there is something called bridge loans. So don't let an opportunity go by for not having this information. So I always say, if you're not sure, always ask. So bridge loans are short-term loans that are anywhere from 6 to 24 months, and they're used to value add to fix and stabilize. So what does that mean? Let's just say that you need to get this loan like pretty quickly, or you need a bridge loan to be able to get you to the next level. A bridge loan would be a good idea for you to be able to get into the property. Any questions about this section here? All right. I'm scared to scroll because it scrolls crazy. So, there it is. All right. So let's talk about using your business to acquire a property. This is a common owner user strategy, aligns operations with real estate ownership. So typically, you're going to want to sit down with your CPA or your accountant or even your attorney, and you may want to ask them of what is going to be the most proper way for you to acquire this property. So it could be that you have a real estate holding company, it could be that you have a trust, it could be that you have an LLC. Essentially a holding company will be an LLC, but just depending on how you need or personally, which I don't really recommend that, especially because if somebody comes in, they fall, something happens, and now you're personally liable for that. So definitely talk to your CPA, your accountant, your attorney to see what the best way for you personally would be to help you limit the liability in case something is to happen. But pretty much what would happen here is you would have the holding company or trust, whoever you're putting the property here. You would have your operating company, your commercial property, and then optional tenant income. So there has been times, like for example, I had a bakery and she had a small little bakery and she said, Valerie, you've been in, and when I first would open accounts back in the day, I would always tell like, you know what, you should aspire to get a commercial property because it's always a talking about it right from the beginning, right? Just have that in mind and thinking about it early on. Well, she ended up saving. I followed a lot of recommendations. I had really good clients that would always follow my recommendations. And one day she came in and she was like, you know what? I'm ready to buy a property. She's like, you said you need about 10%. I saw this property. It has two areas and there's a flower shop there next door. And I was like, okay. I was like, that sounds like a good place. She's like, yeah, but there's an opening where I'm able to put my business, my bakery. Now, the great thing about this is that when she moved in, she got a bigger space. So now people were now spending more time at her bakery. She now had like an espresso machine and like a coffee area where now, she had more premium coffee. I mentioned she had the sitting area, so people were now meeting there longer. She had more space, so she had the ability of having other things there, like little, cups that she would sell, different things. And so people were spending not only more time, more money, and increasing her revenue and her bottom line. But the funny thing about that is that also it worked in line with the flower shop. So typically when you go to a flower shop, you're usually going somewhere. Unfortunately, it could be a funeral or it could be maybe you're gonna go visit your girlfriend, you're gonna go meet somebody at the first time, or you're going somewhere or vice versa. It could be for the both of them, right? Well, what ended up happening is that both the flower shop and the bakery ended up happened to gain money because of those two relationships that were there and they just kind of go hand in hand. So that's actually a strategy that you can use of what type of businesses you should move in so that way you make sure not only that your rent's being paid but you as a business owner when you're moving in it could actually benefit you as well. So I don't know if you've seen but a lot of medical facilities, right, they usually have specialists around, right, like the dentist, the specialist for the heart. I can't think of all the specialists' name right now, even though I work with a lot of doctors. So they would have different specialists there, and they have a pharmacy there, and all of them kind of feed off of each other, right? So that's a strategy. So those are things that you need to think about. Common workflow. So business produces the occupancy need. Financing is structured around an owner user purchase. Real estate is acquired in the operating company or eligible holding structure, and then the business pays for a space that it controls rather than only paying a landlord. So those are some of the things of being able to move your business in, and then also talk about strategy, right? So now if you own the property and you have a certain type of business, you may want to start thinking about what type of business can I move in next door? And you are the landlord, so you decide whether or not you can move them in. It's not something that's forced because you're the owner. All right. There it is. Now, let's talk about acquiring a property and what are some of the things that you want to look out for. And I know that some of you mentioned that you are looking to do it in a year or whatever your case may be, but you will get a PDF format of this presentation so that way you can always refer back to it. But here would be essentially the roadmap in a nutshell of what you would have to do. There's obviously more things, but that's why you need a professional to kind of guide you through. But just so you kind of have an idea of what you need to do, right? So turn the idea into bankable, closable real estate strategy. So first, you're going to assess. So you're going to measure the rent. You're also going to see what type of space, the timing, and your growth plans. But it's very also important that you get somebody that knows what they're doing as far as looking for a property because I have been in the business for quite some time. And when you're buying a piece of real estate, there was one time where one of my clients, he went with a realtor that did not specialize in commercial property. And I don't want to say all realtors are like that, but what ended up happening is that this person um, ended up buying a property that they couldn't use for medical use. So they bought the property, and then once they were, once we were ready to fund and like doing all of the due diligence and everything, um, they had to buy the property because they went through alternative financing. So they ended up not being able to use the property for what they bought it for. Because with medical facilities, and I don't know if this has changed since I did that transaction, they need to have at least 5 parking spaces, or they have to have a certain parking space per square footage. I forget which one it is, but they ended up coming back to me. They're like, Valerie, and I'm like, I we weren't able to approve the loan anyway at our end, so it never moved that far. But to have that lender have that on them, and also not only that, but the realtor. I mean, I don't know, and I don't know exactly what ended up happening. So just be very careful and just make sure that you are doing your due diligence and your research of the type of property that you're getting and what you're able to move in and not able to move in there too as well. So prepare and gather your financials, your tax returns, entity docs, and your ownership story. So those are things that you'll need to also prepare. Pre-qualify, very, very important. You don't know how many times I would tell my clients, I'm like, I can't really do anything until I have all of your information. So now they found a property and I didn't have any of their documentations. And then by the time they got me the documentation, now the property was already sold. So make sure that you are getting pre-qualified, seeing what type of program you're going to be going in, kind of have an idea of what your application looks like so that you're able to move forward. And then pursue and submit a letter of intent. What is a letter of intent? A letter of intent is when you actually have you're actually signing that you're serious about looking for a commercial property, and also being able to underwrite the deal. This makes you at a better position when you're looking for a property to be able to bid with confidence and know that, okay, when I put in my deposit, I'm pretty much already approved. And then finalize the structure, occupy the building, and stabilize the asset. There may be times in where you may need to prepare yourself for maybe that tenant to be able to move out or whatever that case may be. So you just want to make sure that you set yourself for a good position when it comes to that. So long-term wealth and generational impact. So we talked about your rent not going up and down. So typically when you get a commercial property, you have a fixed payment for X amount of years, if not for your full term. So this would be something that you have peace of mind and you have control of. And also if you have, let's just say, a tenant or anything like that, you are able to also be on the other side and increase the rent and things like that. Principal pay down. So when you are able to rent it out and you are able to put in the rent, obviously you are creating equity. Your appreciation potential that could be as aggressive as you pretty much like and are able, and the market allows you to be. And then succession options. So real estate could be sold, refinanced, leased, transferred, or depending on your legacy, could be transferred over to with the right paperwork that could be transferred over to your loved ones. And this is not just about real estate, but it's more about building something that can outlive you. So a lot of the times, this can stay back to your family, or just depending on what you want to do, donate it to charity, have it used for a nonprofit that maybe you're really passionate about. Oh my goodness. Why is it? Okay, there it goes. So let's go through an hypothetical scenario. So there's a service business that you buy at 1.2 million, and then $120,000 down of equity structure is now available. Now, if the business occupies 70%, and then the remaining 30% is leased by another tenant, so meaning you're leasing that out, and now you hold the asset long term while the company operates it. Now, what changes versus leasing only? Your cash flow story. So a tenant might be able to offset your cost, right? And then also you're able to raise the rent because now you're on the other side. your balance sheet story. So what happens to the business? There has been so many times where the client also sells the property, but then also sells the business that's inside it. So this could actually change your balance sheet on your business. So it becomes an asset to the business. So that's something that you can claim. So any type of asset that you have and any type an investor is looking to buy your property, they're probably not going to want to look at your like they would probably prefer to see your balance sheet over your profit and loss because they're like, okay, what type of asset is there? That's probably one of the things that they'll want to take a look first. So that's what investors take a look at first. And then also your exit story. So one day the business and the building can be sold, refinanced, or transferred separately. So we talked about legacy, I think, several times today. So moving from rent to asset owner. So a strategy session. So answer these three things. Is your business financially ready to own? Which capital path makes the most sense right now? So, which type of program are you going to get? Are you going to go through alternative financing? Are you able to go through the bank? What type of financing are you going to be able to get? And then what property profile supports both operations and wealth building? Oh goodness. Ah, there it is. All right, so what did we learn today? So today we talked about owning versus leasing your business, using your business to acquire real estate, qualifying for commercial property financing, and then also building wealth and real estate portfolio. So I'm going to make sure to go ahead and make this a PDF so that everybody can have a copy of it, reference it, and especially for those that are looking to buy soon or buy in the next year, because I think that that's what I read earlier, then you are able to reference back. And then, of course, you have us here for support as well. So now I'm going to open it for any questions. It looks like I have 3 questions. So let me start there. And if you have a little bit more that you want to know, or maybe something today that I didn't cover, feel free to scan this QR code. You can actually book an appointment directly with me, and it'll be a 30-minute session in where I can answer all your questions or guide you in the right direction, or maybe guide you right back to Jeannie. But you have Jeannie as far as a resource, and you have us as a resource, and of course, all of their partners that is a resource as well. Jeannie?
Yes, great. Thank you so much, Valerie. So, should we cover the questions in the Q&A section?
Yes, I thought we start there. So let's see. It says, is this change nudging people into commercial lenders or owner financing? Um, Let me see if Catherine, are you there?
I think Catherine's referring to the previous question about the SBA lender, lenders not lending money to,
Oh, gotcha.
non-US
Okay.
yes, citizens.
So the answer is yes, people are going either to conventional or to alternative financing. So you got to remember this. So SBA has its rules. Those rules we just cannot get over, right? However, so SBA is SBA. However, when it comes to conventional, banks may not require that. So you may want to go through conventional, but what does that mean it comes with? That means instead of like the 10% or 15% that the SBA requires, then you would be actually at 20 to, I think it's like 20 to 35, whatever that may be. So it's just like a higher down payment that you would have to do. But the answer is yes, because maybe that lender does have that same thing guideline as well. So it just really all depends on the lender you're going to, but the answer is yes, they go through alternative financing. If a friend or family member or small investor contributes to the amount of the borrower's needs or present in their SBA loan, does that money need to age in the borrower's account or a certain amount of the time before the loan funds? That all really depends on the lender, number one. Number two, that could also be gifted in some cases, and that might also be acceptable to some lenders. It all comes down to the lender. So if you have a specific scenario or anything like that, you may want to inquire to that specific lender to get that answer. But the answer, so hopefully that answered your question. If you have an LLC for your business, should you start another LLC, which is the borrower for commercial property, which might go also be a landlord for tenants at the same property? So that question most likely is yes. However, it goes on a case by case basis. And it also goes on your tax situation and your wealth situation and how you're structured. The best way and the best route that I can give you, advice that I can give you, is consult your CPA or your accountant or attorney, because they will know your situation better than anybody else. And it's all about protecting yourself, your wealth, right? Your home. So you want to make sure that you have a strategy for that to be able to protect yourself. But in some cases, I have had clients, just so that you know, that they have some properties in the trust, some property in the LLC, which is also a holding company. And then I've even had some people, and I'm like, why do you have that in a personal name? And personal name, if that's, something could happen and they can sue you personally. So just make sure that you're getting the right advice at the right place. Awesome. Any other questions?
Perfect.
Is there any questions on the chat?
Oh, I don't think so. I didn't see any questions there. We have
Actually, there's one. Isn't there a trend of low occupancy for office and higher on retail industries and multi-family? Actually, Laura, for that, it really just depends on case by case of what area you're in. So you definitely want to review the market that you're trying to buy in, because there's some areas that it might be the other way around, right? So it really just all depends on what market you're trying to penetrate. Um, Ray's looking for a clean manufacturing building at year end. Well, definitely you should start looking now and definitely start preparing, so that way you have an idea of what you need to work on, especially if you haven't filed your taxes, Ray. That's definitely something you need to do now, because tax season is coming up, or we're already in it actually. And you want to make sure that you position yourself correctly. And not only that, the better position you are, the better rates and the better terms that you'll be able to get. Thank you, Christopher. Dyra, thank you for putting the link on being able to book an appointment. I want to
okay.
open a pit barbecue restaurant, Los Angeles. I don't know what areas would allow this type of restaurant. So, Diane, that's definitely having a commercial realtor that's going to help you with that. And if it's a startup or anything like that, there is financing that is available out there, and definitely would, there's resources out there that will be able to help you with the projections and everything to be able to make that happen. But I think not I think, I know that the best way of finding that out is finding an expert in Los Angeles. If you don't know anybody, Diane, I have a realtor in Los Angeles, a commercial realtor that has been doing it for quite some time. That is one of our trusted partners here that might be able to guide you as to where to find a property that can do that. But congratulations on that, and congratulations to all of you that are taking that step and actually taking the time also as well today to be able to learn this information. And as I mentioned, if I did not cover it today or you have a question, feel free to send me a note, schedule an appointment with us so that we can go ahead and answer the questions that you need. We definitely would love to stay in touch, so feel free to scan our QR code. There is a podcast that is coming that we are going to be sharing resources, and we're going to bring in different subject matter experts. So I already have Pace on the line that they're going to come in and share their resources. So think about the podcast that's coming. You have to be able to, one, if you're going to be on my podcast, you better help my business owners and provide a resource. Number two, you have to be able to scale up my businesses, so provide information. So that could be maybe access to capital or an AI expert that's going to make your life easier and make you go to the next level. Three, you have to be able to protect my business owners. This could be like cybersecurity, HR, and maybe you have employees. And then number four, if you don't have any of those three, then you must be able to be a business owner or somebody of power that's going to help my business owners. So definitely scan the middle one. Would love for you to subscribe. Visit our website for more information. And yes, we are calling it Power Moves with EVS. So it's going to be every Tuesday at 7 a.m. going live. So really looking forward to the resources I'll be able to bring to the business owners and just continue my mission, which is the reason why I went on my own. So thank you, everyone. And thank you, Jeannie. I don't know if anybody else has
Great.
anything.
So much awesome information, Valerie. And I love your picture there.
Thank you, thank you. I'll try to clean up that day.
All right, folks. Well, PACE is another great resource if you're looking into SBA loans, and PACE also offers PACE Financial separate from SBA. So even if you're not a U.S. citizen, there could be an alternative option for you. So please check our website, pacebdcla.org, for more information. And stay tuned. We have another webinar next week with Valerie, same time, Thursday, April 15th at 1 p.m. And we'll be covering lender ready building business credit. So make sure you join us for that as well. All right, that's it for
Awesome.
today.